Welcome back to the Strategy Desk, the podcast where we take a corporate annual report apart the way a strategist would, not just as a stack of numbers, but as a story of how a company competes, allocates capital, and creates value. I'm Nandana Veerasinghe, and good evening. Welcome to the second episode of the Strategy Desk. In episode 1, I walked through Ranasinghe and Dhanansurya's piece, Viewing Corporate Annual Reports Through the Strategic Lens. The idea is simple: move systematically through the chairperson's statement, the business model, the strategy section, the risk section, governance, and finally the numbers. And you can reconstruct a company's real strategy, not just what it claims about itself. Today, I am applying that exact framework to one report, John Keels Holdings PLC's annual report for financial year 2025-2026. 612 pages, Sri Lanka's largest diversified conglomerate by market capitalization listed on the Colombo Stock Exchange. Big number to open with. Group EBITDA of 80 billion, up 75% year on year. That's literally the headline on the cover of the report. Our job today is to work out whether that number is a strategy paying off or a one-off. Before we get into it, quick note. If you are into financial reports or you are a student of strategic financial analysis, this series is for you. Subscribe and share this episode with someone who would enjoy it too. Also, a quick note on the next slide about how to treat everything you are about to hear. Then let's get into it. Quick but important note before we start. This episode is an educational exercise in reading an annual report through a strategic lens. It is not investment advice. Nothing I say today is a recommendation to buy, sell, or hold shares in John Keels Holdings or any other security. All the figures I'll quote come directly from JKH's own published annual report. The interpretation, the strategic framing, and the scorecard at the end are my own independent analysis and may not match how the company itself would characterize its results. Past performance is exactly that, past, and isn't a guide to what happens next. If you're making an actual investment decision, please do your own research and speak to a licensed financial advisor. And to be clear, the strategy desk isn't affiliated with or sponsored by John Keels Holdings in any way. With that said, let's get into the report. Here's the route we are taking today. Vision and strategic direction first, then the business model, the risks, how capital gets allocated, the big strategic moves this year, governance and people, and then we close with a deep run through the numbers, revenue, returns, debt, and dividends. Let's start where the framework tells us to start, right at the top, with what the company says about itself. Step 1 in the framework is the preliminary assessment. Read the About section and the chairperson's message before anything else, because that's where a company tells you, in its own words, where it thinks it's going. JKH's stated vision is deliberately short: building businesses that are leaders in the region. Five values sit underneath it: caring, excellence, trust, innovation, integrity. Notice it's not the biggest conglomerate in Sri Lanka. It's regional leadership, business by business, and that maps directly onto what the group actually is. Not one business, but seven industry groups: transportation, consumer foods, retail, leisure, property, financial services, and other, which covers information technology and plantation services. Over 18,500 employees across the group. This year's chairperson's message is signed by Krishan Balendra, and the tone is interesting. It isn't, "Look how well we did." It is, "We've crossed an inflection point." His exact words: "We have crossed an inflection point of moving from capital deployment to cash generation." That's a strategic claim, not just a financial one. For years, JKH has been pouring capital into two enormous projects: City of Dreams Sri Lanka and the West Container Terminal at the Port of Colombo. Both went live and started contributing meaningfully this year. So the chairperson is essentially telling shareholders the hardest part of the journey is behind us, which is exactly the kind of claim the framework strategy implementation step warns us not to take at face value. We'll come back and check whether the numbers actually back it up. Next in the framework is the business model section. What resources go in, what activities create value, and critically, how the portfolio is structured. This is where you actually read a company's corporate level strategy. JK, JKH is a textbook case of a diversified conglomerate, a portfolio of businesses under one holding company, container terminals sitting alongside a five-star integrated resort, a supermarket chain, an insurance company, a confectionery business, and now an electric vehicle dealership for BYD. On paper, that looks like unrelated diversification, which classical strategy theory treats with some suspicion. The so-called conglomerate discount, lack of synergy across businesses. But look closer, and there's a logic underneath it. Most of these businesses cluster around two structural bets on Sri Lanka: the tourism and travel value chain, and the Port of Colombo's position on global shipping lanes. Transportation covers the port and bunkering. Leisure is hotels and the integrated resort. Even property with waterfront and the new Vauxhall project sits right next to that tourism corridor in Colombo. So it's less unrelated diversification and more a concentrated bet on Sri Lanka as a regional hub, spread across the industries that benefit from that thesis. And the corporate parent in logic is explicit. JK doesn't just hold equity passively. It actively manages the portfolio through a five-step capital allocation methodology, which I'll unpack next. That's the difference between being a holding company and being a genuine strategic parent. The framework's next step is risk assessment. And this year's key risk section is genuinely useful for reading JK's external environment. Sri Lanka's macro backdrop actually improved: 5% GDP growth in calendar year 2025, reserves up to around 6.8 billion US dollars, continued adherence to the IMF program. The group actually downgraded its own assessment of macro political risk this year, but two new pressures show up. Cyclone Ditwa hit in November 2025, a brand new risk category this year, causing temporary disruption that the group says its business continuity plans absorb without material damage. And right at the tail end of the year, the Middle East conflict closed shipping lanes, disrupted flight paths, and a real hit to tourist arrivals in exactly the quarter city of dreams needed momentum. That's a nice test of the resource-based view of strategy. Are JKH resources and capabilities actually a source of resilience? The report's own answer is that diversification itself is the buffer. Foreign currency exposure in leisure and transportation naturally hedges against a weaker rupee, and having seven industry groups means a shock to tourism doesn't sink the whole group. On capabilities, the two resources JKH keeps returning to are its Colombo Land Bank and its position at the port. Those are genuinely hard to replicate. That's a classic resource-based weave test: valuable, rare, difficult to imitate. And then there's a risk that's less external and more a live internal question. Global competitiveness and portfolio imbalance is explicitly listed as a key risk in its own right. In plain language, the group is flagging that City of Dreams is now so large it's distorting the balance of the portfolio. That's kind of self-aware disclosure is rare. A company naming its own strategic concentration risk in black and white. This is really the heart of today's episode: how JK chooses where to compete and when to move. The report lays out a five filter methodology for every investment decision. A financial filter based on a group hurdle rate of 15%, a growth filter that looks at industry life cycle, a strategic fit filter assessing competitive advantage and control over value, a complexity filter, and a sustainability filter. That 15% hurdle rate is essentially their weighted average cost of capital plus a value creation premium. Every major project, City of Dreams, the port terminal, the EV business, had to clear that bar before capital was committed. It's a disciplined, almost private equity style stage gate process sitting inside a public conglomerate. And it isn't just a management exercise. The board's project risk assessment committee has mandatory involvement above a set investment threshold. So this framework is embedded right up to board level, not just used as a slide in an internal deck. On timing and scope, three moves stand out this year. First, City of Dreams Sri Lanka finally completed and turned EBITDA positive after years of construction. That's a scope play. An integrated resort combining hotel, retail, conferencing, and gaming under one roof, aimed squarely at the premium end of regional tourism. Second, the West Container Terminal, WCT1, hit full utilization of its first phase in its first full year of operation, running ahead of schedule on phase 2. That's a scale and first mover play at the Port of Colombo, riding the tailwind of global shipping reroutes. 3 is a very strategic move, the one that surprised a lot of analysts. John Keels CG Auto, the BYD electric vehicle joint venture, was consolidated as a subsidiary this year and had, in the chairperson's own words, an exceptional year on pent-up demand after vehicle import restrictions eased. In generic strategy terms, that's a genuine market development and product development move and soft matrix territory, moving into a new product category, new energy vehicles, riding a structural shift toward EVs in a market JKH already understands well through its existing dealership relationships. So, what's the underlying competitive strategy at business unit level? It isn't cost leadership across the board. Retail supermarket arm competes partly on cost and convenience, but leisure and property are unmistakably running a differentiation focused strategy, premium branding under the Cinnamon name, integrated luxury experiences targeting a specific high value traveler segment, not mass market tourism. So, corporate level, a diversified portfolio bet on Sri Lanka as a hub, business unit level, a mix of cost focus in retail and differentiation focus in leisure and property. That's coherent, not scattershot. So, strategy isn't just what you buy, it's what you sell. This year, JKH executed several deliberate divestments. They exited their stake in T Smallholder Factories PLC, sold their stake in Fairfax Insurance, and divested their entire equity stake in Candy Walk In, the company that owns Cinnamon Citadel Candy, while retaining the management contract. That last one is a clean case study in asset light strategy. Give up the balance sheet exposure of owning the hotel, keep the brand and the management fee income. It's the same model behind the newly launched Candy Missed by Cinnamon, where JKH holds only a minority equity stake plus a long term management contract. These moves need to be carefully analyzed. And on the property side, the launch of Vauxhall DSTRCT is about monetizing a land bank in Colombo 2 rather than sitting on it, turning a static asset into a cash flow. All of that is explicit capital recycling, freeing up capital from lower returning or non-core assets to redeploy into the higher conviction bets. It's disciplined portfolio management, and honestly, it's the part of the strategy section that most convincingly resonates through the rest of the report. Exactly the test the framework asks us to apply. Does the strategy narrative actually show up as action elsewhere in the document? Now, let's move into people, culture, leadership, and governance of the strategy. Strategy doesn't execute itself, people and governance do. Two things stood out to me in the human capital and governance sections, and let's look at those sections carefully. On people, JKH completed a project this year with an external global consulting firm to formally define its employee value proposition, alongside a full review of total rewards and a new employee engagement survey. That's a company treating talent retention as a strategic input, not an HR afterthought. Sensible, given that 18,558 employees are the ones actually running 7 very different businesses. Interesting to read. On governance, the board doesn't just approve strategy after the fact. There's a dedicated board subcommittee, the Project Risk Assessment Committee, whose entire mandate is to scrutinize large new investments before capital is committed. Mandatory involvement above a set threshold. That's the board embedded directly inside the 5 filter capital allocation process I described a few minutes ago. There's also a quieter operational story. The group completed a group-wide migration to SAP RISE, a cloud enterprise system, this year, alongside a shift to a zero-trust cybersecurity model. That strategy supportive infrastructure. You can't run a disciplined, data-driven capital allocation process of fragmented legacy systems. Let's look at financial results, revenue and EBITDA by segment. This is the part I've been waiting for. Does the strategy actually show up in the numbers? Group revenue, excluding equity accounted investees, was 528.9 billion rupees, up 67% a year on year, including the group share of associates and joint ventures. It's 572 billion rupees, up 61%. And that growth is not evenly spread. This matters for reading a diversified company properly. Retail alone grew 127% to rupees 313.9 billion. On revenue excluding associates, that's 59% of the group. On the broader revenue base, including associates and joint ventures, it is 55%. Either way, retail is now JK's single largest segment by revenue. Nearly all of that growth is the new BYD electric vehicle business, plus continued double-digit same-store sales growth in the supermarket chain. Leisure grew 34% to 66.8 billion as City of Dreams ramped up. Property grew 38%, financial services 20%, consumer foods 15%, transportation 14%. Only the small other segment, IT and plantation services, declined by 33%. Group EBITDA hit 80 billion rupees, up 75%. Recurring profit before tax more than doubled, up 143% to 35.7 billion. And recurring profit after tax was up 216% to 21.4 billion. That's the scale of the swing we are working with as we move into the ratios. Analysis for ROCE, ROS, and ROE, revenue on equity. Group return on capital employed rose to 9% from 5.1% the year before. The report breaks that down using a three-factor decomposition. EBIT margin improved from 9.2% to 10.7%. Asset turnover jumped from 0.44 to 0.64 times, and the capital structure leverage component was broadly flat at around 1.3. So the ROS improvement, ROC improvement is coming from genuine operating performance and better asset utilization, not from taking on more leverage. That's a healthy improvement. Here's a number that really tells the City of Dreams story. Strip the integrated resort out entirely, and the rest of the group's ROCE rose was 16.9%, up from 11.1%. So the underlying mature portfolio is performing strongly. It's specifically the still ramping resort investment that's dragging the consolidated number down. On to return on equity, a DuPont breakdown again. ROE, return on equity, rose from 1.4% to 3.4%. Return on assets improved from 0.9% to 2.5%. That's the big driver. The earnings leverage component, essentially how much of pre-tax profit converts into profit attributable to JK shareholders, actually declined slightly from 0.77 to 0.62 because non-controlling interest took a bigger share of the growth, particularly from the new NEV subsidiary. The equity multiplier was roughly flat. So overall, rise in profitability driven by operations rather than financial engineering, but a growing share of that profit is going to non-controlling interest rather than JK's own shareholders. worth flagging for anyone valuing the stock on a per share basis. And that leads us straight into the debt picture. Let's have a deep dive into the debt situation of JKH. Let's spend proper time on debt because the headline number understates a more nuanced picture. Group debt, excluding leases, rose 13% to 238.1 billion. Net debt rose 18% to 137.2 billion. Where did that increase actually come from? Two distinct sources. First, higher trade-related short-term borrowings, about 24 billion this year versus roughly rupees 7 billion last year, concentrated in the NEV business and bunkering. Both are inventory-backed and self-funding. As trading volumes scale, the working capital facility scales with them. That's not the group taking on structural leverage. It's the mechanics of financial physical inventory. Second, holding company net debt rose 45% to rupees 50.2 billion on an 11% rise in debt and an 8% fall in cash. That's largely mechanical too. Proceeds from the October 2024 rights issue, which had been temporarily parked reducing overdrafts last year, were fully deployed into waterfront properties and CODSL this year. So the increase is really the planned use of money the group already raised. On the ratios, debt to equity actually rose slightly from 50.2% to 54.1%, and net debt to equity ticked up from 27.8 to 31.2%. So against the balance sheet, leverage looks a touch higher. Quick transparency note here. The report itself quotes debt to equity two different ways in two different sections. The figures I'm using exclude lease liabilities, which is the basis given in the Financial and Manufactured Capital Review. But the decade at a glance table elsewhere in the report quotes a higher debt to equity around 62% this year, 57% last year, because that version includes leases. Both are correct on their own terms. I'm just flagging that a reader jumping between sections of the report could otherwise read that as an error. But look at leverage against earnings power instead, which is the more meaningful lens for a company mid recovery. And it tells the opposite story. Debt to EBITDA improved sharply from 4.6 times to 3.3 times. Net debt to EBITDA improved from 2.5 times to 1.7 times. Interest cover improved from 1.8 to 2.5 times. That's a growing into the balance sheet story. EBITDA grew faster than debt did. One more nuance worth flagging. The debt mix quietly got shorter dated. Long-term debt as a share of total debt fell from 65.2% to 45.5%, precisely because so much of this year's new debt is short-term trade finance. That's worth watching, though it's structurally lower risk debt than a longer-term bullet loan. On refinancing, the 189 million US dollar term loan at Waterfront Properties was refinanced in March 2026 into a 150 USD million 5-year facility with a grace period and back-ended repayments, plus a 39 million US dollars 6-month bridging facility at a materially lower interest rate than before. That directly reduces future finance costs subject to currency translation, and on currency around 335 million US dollars, roughly 44% of group debt excluding leases, is foreign currency denominated, down from about 55% last year. The holding company's 180 million US dollar cash position almost fully offsets the 136 million IFC loan. So the real net foreign currency exposure across the group is only around 120 million US dollars, much smaller than the gross number suggests. The one segment where gearing genuinely still looks stretched is CODSL itself. Net debt to EBITDA there is still around 37 times, simply because EBITDA has only just turned positive of a very low base. That's the concrete, numerical version of the portfolio imbalance, risk the group flagged against itself earlier. So the fair summary: gross debt is up, and it's genuinely worth watching that the debt mix has shifted shorter term, but leverage measured against earnings power, the ratio that actually determines whether debt is serviceable, improved meaningfully across the board, and the forex risk is more contained than the headline exposure implies. Let's deep dive into the dividends. Dividends, because the headline is a bit misleading if you stop at the first number. The board declared a total dividend of 0.30 rupees per share. 0.30 rupees per share for 2025-26, exactly double the 0.15 rupees per share declared for 2024-2025. That came in three tranches. The first and second interim dividend paid in November 2025 and February 2026, and a 0.10 final interim declared for payment on or before 24 June 2026. Total cash outlay 4.42 billion, up 80% from rupees 2.46 billion the year before. But here's a number that actually tells the more interesting story. The payout ratio, calculated here as total dividend paid divided by profit attributable to equity holders of the parent. Even though the dividend nearly doubled in cash terms, that ratio actually fell from roughly 46% last year to about 32% this year. Worth being precise about why. Profit attributable to the parent grew 156% from 5.3 billion to 13.4 billion, even faster than the 80% growth in the dividend itself. So the board increased the dividend generously in absolute terms while actually retaining a larger share of that profit pool than it did last year. One nuance for anyone deriving this: dividing dividend per share by EPS gives a different number, about 39%, because dividend paid in the cash flow statement mixes tranches declared in different financial years, while EPS and the per share dividend are both tied to the current year's declaration. The 32% divided by 46% figures I am using here rest on the cleaner profit attributable basis. That consistent with the group's own stated dividend policy, which the chairperson describes explicitly. Dividends correspond with growth in profits, while the company keeps adequate funds to fund its pipeline of strategic investments. Close brackets. It's a growth linked policy, not a fixed payout target, and this year is a clean example of it in action. Worth a bit of 10-year context too. Dividend payout were far larger in absolute terms before 2020. JKH paid out over 8 billion rupees in dividends back in 2017 and 18. The multi-year capex supercycle behind City of Dreams and the port terminal suppressed distributions for years. This year's near doubling is arguably the first real signal that the board is beginning to normalize shareholder returns as that capex cycle winds down. Right alongside the deleveraging story I just walked through on the debt side. In other words, the board is trying to do three things with the same pool of cash at once: keep deleveraging, keep funding the next pipeline of investment, and start rewarding the shareholders who sat through the capital intensive years. So finally, we move on to the verdict and future outlook. Applying the framework's core test, does the strategy narrative actually resonate through the rest of the report? That's what we've been trying to analyze right through. On resource allocation, yes, the five filter hurdle rate framework shows up directly in the year's biggest decisions. On risk management, yes, mostly the groups is unusually candid, naming portfolio imbalance from City of Dreams as a risk against itself. On governance, the Project Risk Assessment Committee gives a direct, verifiable link between strategy formulation and board oversight. The one open question is the outlook itself. The Middle East conflict remains an unresolved near-term risk to the resort's tourism recovery, right in the segment that most needs to keep ramping up for the inflection point. Story to hold for a second year running, which is really the right note to close on. For JK this year, on balance, The story and the numbers largely line up. That's my strategic read for the 2025-2026 annual report. All figures quoted come directly from the report itself. And as a reminder, none of this is investment advice. In next episode, I'll take this same framework to a different sector entirely. With that, I would like to wrap up. And this is Closing the Strategy Desk second episode. And thank you for listening. And if you liked what you listened to, please subscribe and share. Have a good evening.